As we get close to wrapping up 2025, what have been the biggest forces shaping the economy, and what surprises might 2026 have in store? How might central bank decisions and shifting market dynamics impact investors and businesses in the months ahead? We're going to get into all of those details with Dr. David Kelly right now on UBS Trending. Hi, everyone, and thank you so much for joining me today. I'm Anthony Pastori, and this is UBS Trending. I'm so pleased to welcome back to the studio my guest, Chief Global Strategist and Head of the Global Market Insights Strategy Team for JP Morgan Asset Management, Dr. David Kelly. David, nice to have you back in. It's always good to have you sitting at the table with me.
Great to be here.
Yeah, and I know that we and our advisors and our clients really appreciate your insights and making time for us. I want to kind of just put your economic lens on, which I know you probably have on all the time. What do you think, if we look back at 2025, I mean, it's been a really interesting year with between tariffs and artificial intelligence and the way the markets have been making record highs almost every day. When you look back at the major drivers, what do you think they were as so far? I mean, we're sitting here at the end of October. What did 2025 look like?
I think the first thing is to recognize just what a really unusual situation we have right now. Because if you look at consumer confidence or consumer sentiment, things are horrible. If you look at the economy itself, I would say it is resilient, it is slow, but it's sort of, as I've said for a number of years, it's kind of like a healthy tortoise. It sort of just crawls forward about 2% per year, but it's doing okay. And then you look at the markets, and it is all champagne and sparkles. I mean, we've had an extraordinary stock market this year, after two very great, very strong years before.
Yeah.
But the economy itself, I think, resilient is really the word. I think we've had, policy shocks in terms of tariffs. Initially in April, a lot of people thought that was going to be very bad for the stock market, very bad for the economy. I think it still is going to push up inflation and slow economic growth in the fourth quarter and have that kind of impact going into next year. But the economy's been able to deal with it. We've also had a big change in immigration, which has tended to slow the economy. But on the flip side, we've got sort of three things that I think have really helped. One, we've had this huge continuing boom in AI investment. And of course, it's the chip makers, but it's also the AI companies themselves. It's the hyperscalers who run these huge clouds where all these calculations are done. It's the data centers. It's the electricity to go into the data centers. And that part of the economy is absolutely booming, and that's really helping. I think a second thing is just a wealth effect. Talked about what gains we've seen in the stock market so far this year, but this is real wealth for Americans, particularly for upper income Americans. And so what I think we have is a sort of a K-shaped expansion with the richest households doing better and the majority of households actually not doing that great. But the top 10% of households get 50% of the income and account for something close to that in terms of spending. So that's helping. And then the OBBBA, the tax bill, I think it's helped with investment spending this year, and it's going to help with consumer spending next year. So overall, I think the economy still, went into this year, we thought it would be what I'd call a 2024 economy, 2% growth, 0 recessions, inflation coming down to 2%, unemployment of 4%. I think by the end of the year, the unemployment rate will be a little higher, inflation will be a little higher. But as we go through next year, I think we're still, that's a baseline forecast. We can still tend to grow at a steady pace. And I think inflation will go up, but then I think it'll come down again later next year.
Yeah, it's interesting that you talk about that K-shaped economy, because we were just talking about this with one of my colleagues in CIO. They've done some studies, and it looks like there is a lot of anxiety out there, especially with middle income families in America, and it's those top earners that feel everything is doing just okay. And it's a really good point that you bring up, and it's important to remember that it's not equal across the board. We've got a Federal Reserve that has a big job, and they're not getting as much data because we're currently still in the government shutdown, so jobs numbers aren't coming out, which has been one of their, obviously one of the bigger pieces of data that they've been tracking. But we are getting inflation data, and it's steady, but still up, versus where the Fed would like it to be. How do you see the Fed's path evolving? Just to back up, our CIO here expects between September and next spring of 2026 a total of 100 basis points of cuts. I think that's pretty much what most are expecting. Yeah. What do you think about the Fed's path?
We tend to agree with that. I mean, to be honest, I don't think they should be cutting. And I know that may be a minority view, but to me, the Fed's moves don't really move inflation or growth that much. But what they do is they move asset markets. And when you've got a lot of liquidity out there, and that has been pushing up asset prices. And if you think about what's really hurt us this century, it's been asset bubbles. You had the tech bubble, you had the housing bubble. Now I think you've got a tech boom, which I think you could certainly argue is close to bubble terms. And it's we've got all these unleashed animal spirits. But if you go into the zoo, it says don't feed the animals. And I feel like the Fed is feeding the animals, and they shouldn't. So I don't really think they should be cutting. I think 4% federal funds rate is fine. We don't need more juice for this. I know we're all making money out of it, but the problem is it's increasing inequality, and a bubble eventually bursts. So I feel like the Fed shouldn't, but I think they will.
Right.
I think the reality is they're not that worried about inflation in the long run. They are somewhat worried about employment growth. I think that's fair. I think they are worried that they just don't know where things are going and what tariffs might do to slow the economy down. So I think that, and the other thing is, this is a kind of tricky subject, but I really don't think they want to pick a fight with the administration. They value their independence. And if they think if the Fed thinks the neutral rate's 3%, if they gradually come down to that neutral rate, then I think they feel like let's just do that rather than pick a fight which could cost us our independence. And I think that's why they're continuing to cut interest rates.
Right, and Powell's near the end of his term as the Fed governor and Fed chief, and so I think it's February or March of 2026 he'll be replaced with someone else. So maybe he's just. I agree with you. I think there is a lack of just don't want to get into any kind of altercation. Let's just make this happen. And
I do think the Fed will maintain its independence,
right,
because we've obviously seen the names of some of the leading candidates, and I don't think you'll see a radical shift. I think the administration recognizes it's important to have somebody of some substance in that job who knows how to do the job. But the institution itself, I think it's important to look at the structure of an institution, the way it's built. And the Federal Reserve is built to be independent. And I think that, I've heard some sort of alarmist talk about, replacing Federal Reserve Bank presidents and stuff. I don't think that's going to happen.
Right.
I think the Fed will be a little easier than I would be in that situation, but fundamentally I think they'll be able to retain their ability to make independent decisions on the economy.
I'm surprised they're not asking you to sit in that seat. I mean, you're somebody who's very well known to understand the U.S. economy, so, wouldn't be surprised.
Well, I would.
Yeah, that's the humbleness of Dr. David Kelly. It is interesting because you did bring up the word bubble, and we've asked the question before, are we in a tech bubble? And obviously, you made a really good point as well. The last 2 years of S&P 500 gains were in record territory, 24% each year, 23, 24. 2025, we're already up 18% as of right now, and we're looking to continue that run. Is this a bubble? I mean, our equity is in a bubble right now.
Well, eventually some parts of the equity market will end up in a bubble. I am worried about valuations being very high here. And I think that the issue is this. I mean, AI is going to change the world, just like back in the dot-com boom.
Right.
The internet changed the world. The question is everybody's strategy exactly right here? That's one question. The second thing is, the kind of generalized AI they're working on, is that going to have such a significant impact in terms of actual productivity that people are going to be willing to pay for, to ultimately pay the people who are building the data centers, to buying the electricity, buying the chips? It's quite possible that different companies will get out over the skis here, or it's possible that there's going to be a lot of competition where this AI bot is ahead this month and some other AI bot is ahead in 2 months' time, so you pull down the prices. And I think we've really got to be careful here, because it's really fun to ask an AI system, how can I find the best recipe for a blueberry torte? But that's not actually going to change productivity. And I've got massive supercomputers whirring away in the desert to try and figure this one out for me. Eventually, there's going to be some problems. So we saw that in the dot-com bubble. It wasn't clear at the time who the eventual 2 or 3 huge winners were going to be. And I think we've got to be sober about this here. There may come a time where everybody's looking at this much more carefully and decide to cut back on some of the capital spending, cut back on some of this AI spending, and that could leave some companies in an awkward position. For investors, just be careful here. You can see the exuberance. We've been through this before, so make sure you're balanced.
Yeah, and obviously there are so many AI adjacent sectors of the market, the energy sector, even the real estate sector. As these data centers pop up, they need the land. They need to purchase the land and then build the data centers on top of them. There's so many, and even if you look at small and mid cap, there are so many smaller companies in there that are providing components, for example, for AI. So it's a huge story, and obviously that's the risk there. If you talk to investors about risk, what do you tell them?
Well, that's right, because of course you've got an economic story, but you've also got a market story. And if you remember the two of the three things I said when I was making the economy resilient, is this actual economic power from the AI boom, but also the market power of this because of what it's doing to wealth in this country. So if you lost both of those things at the same time, very much like we saw back in 2000,
right,
then you could have a problem. And again, we're not predicting that. I think it's different. I think it's not being led by a lot of small companies. This one, you have to be a hyperscaler. You have to be able to afford these enormous supercomputers and clusters of cloud computing power in order to be a competitor in this. And these companies have a lot of cash they can put into it, but still, it's too easy to just get too exuberant. Right. And I think investors need to just be careful about that. Make sure you've got some money invested overseas. Make sure you've got money invested in alternatives. I mean, just spread it around, because if you just passively become overweight, like the indices are getting overweight, you get burned. And if you think about the two big bubbles in the first decade of the century, market went down 50% both times. The Nasdaq went down 78% when the dot-com bubble burst. So you've got to be careful.
It's easy to forget that. I mean, it was such a shock. And we've seen such gains that people forget that, that can happen.
Well, that's right.
Yeah.
And people are wealthier, and they can, in many cases, can afford to rebalance, and they should.
Right. And on the allocation side, you sort of quickly mentioned it. It seems like, it's the 60-40 portfolio allocation barely exists anymore. We have preferred attractive ratings on EM, on fixed income, on U.S. stocks. So what does an allocation of portfolio look like to you?
The first thing I'd say is in our guide to the markets, we have this chart which shows that if you were 60-40 on January 1st, 2019, and you didn't rebalance, and all the dividends went back to the stocks and the coupons went back to the bonds, you got a 75-25 portfolio today. So right off the bat, check your balance. But also, we think very much of beyond 60-40. And so if you sort of reduce proportionately the 60% of the 40% for stocks and bonds, add in alternatives, things like real estate, infrastructure, global transport, if you can, as ways of doing that. But also, as you said, within equities, it's not just about US equities. We do think the dollar is on a long-term downtrend. That's one of the reasons why this year international is way outpacing US equities. And that could happen for a number of years. I mean, if you have a long multi-year downtrend in the dollar, I think you will have a long multi-year period in which international investments outperform. And what I find talking to financial advisors is nobody is overweight international still. So I think just trying to get back to a normal international equity allocation, I think, is very important.
Excellent. Dr. Kelly, thank you so much. I always wish we had more time. It's great to be with you.
Anytime,
Thank you so much. Great to see you. Dr. David Kelly from JP Morgan Asset Management and more. And if you would like more from JP Morgan or any of our partners, including our Chief Investment Office here at UBS, please visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We are on LinkedIn and Facebook. You can also follow us on Instagram at UBS Trending. There's lots of content there for you. And as always, if you have any questions about what David and I spoke about today, please make sure you are connecting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.